don't own these 4 stock sectors. Now today we're going to talk about 4 sectors that are typically unlikely to rise during the summer months and into the early part of the fall. At the end of the video, I'll also talk about 2 sectors that do tend to rise into the fall, and we're not just going to be looking at the seasonals, we're also going to be looking at the stock charts themselves to see if these charts agree with the seasonal patterns. My name is Keith Richards. I'm a technical analyst, and I'm president and chief portfolio manager at ValueTrend Wealth Management. And this is the Smart Money Dumb Money Show. And you guys know you're watching the show, so you're smart money. Let's get at it. Now, I'd like to start off the show by talking about how even though these sectors are often seasonally unattractive until, say, early winter or late fall, doesn't mean that if you own the sectors now, you should be bailing out. What I'm trying to give new investors or investors with new money to put into these sectors a bit of a heads up, just an understanding that they may not go anywhere for a couple months, so there's no hurry to rush into the sectors. So these are not necessarily sectors that are going to plummet, but they are sectors that we probably should be slow or cautious on buying for now. And we're going to start off with gold. Now, you guys know I have been talking about gold since middle of 24. In fact, I caught gold on the breakout and we're up substantially since that point, literally 100% return since I started talking about gold. So I'm still a gold fan, but like everything, there are rotations, there are seasons, and there are technical rhythms to markets. And so I want to talk a little bit about that rhythm on gold today. Some of you guys know that the US dollar is a primary driver of gold. Investors move into gold when the US dollar is weak and vice versa. In fact, this relationship is probably one of the strongest ways of predicting gold in the near term that there is. The relationship has been a almost perfect negative correlation over time. So let's take a look at the chart. And the thing I want to point out before we even look at the chart above is this is the correlation line. And what you're going to see is the middle line is a non-correlated line. In other words, a zero correlation between the two, between the US dollar and gold. Well, what you can see here is that most of the time, the relationship is negative. It's below the zero line, meaning that gold is actually most of the time, not always, but most of the time moving in the opposite direction of the US dollar. People move into the gold area when they have beliefs that the US dollar is not going to do well, but vice versa. People move into the US dollar if they feel strong and they stop buying gold. So let's take a look here then at the chart. The red line is the US dollar. The black line is gold. And what we can see here is that, indeed, there's an opposite rhythm. The US dollar was falling, gold was stable. The US dollar was rising, gold went down, on and on. The two often move in either opposite directions or non-correlated directions. So off and on we'll see this. So US dollar was falling, gold rose. Over and over again, US dollar fell, gold rose. Same thing, over and over. Well, that's where we are right now. Now, I've erased the lines on the chart just to show you guys the current relationship between gold and the US dollar. And as you can see, the relationship, that negative correlation, is beginning to hook up. We're starting to see a little bit move towards the dollar outperforming gold. And you can see that on the chart here. The red line is just starting to move up and gold is just starting to, it's still moving up, but move more or less sideways. It's certainly weakened from his very strong move prior to the past month. So what I'm going to suggest is over the near term, the US dollar, I think, has some potential technical upside. And in fact, if you click on the link below, you will see a video where I talked about why I feel the US dollar is going to rise over the coming months. I called it the free lunch, and you can see the video below, and I really encourage you to watch it because I do think there's a play on the US dollar strength in the near term. So that's going to play negatively against gold based on this negative correlation between the two assets that we've seen over history. Now let's take a look at gold futures. So this is seasonality of what gold tends to do in the short futures contracts. And you can see that during July, no surprise, gold moves up a lot. And that's what we saw between June and July. Typically, between about the end of August and about November, gold goes fairly flat. So this is what I'm talking about from a seasonal perspective. Gold can take a bit of a breather over a couple of months in late summer, early fall. That will probably give the US dollar room to move up. Actually, it's the US dollar that usually leads gold. But whatever the case, we're starting to see the US dollar catch a little bit of a bid, and we'll likely see gold take a bit of a pause over the next few months. That doesn't mean a plummet. Will I be selling my gold? No, I will not be selling my gold. But what I'm saying is that you'll probably see gold take a bit of a rest. So there's no rush to continue buying gold if you are doing so. Now let's take a look at the gold stocks. And in fact, this is the way I largely hold gold within the value trend portfolio. We hold gold stocks. We also hold silver stocks. In fact, we're favoring silver, and some of you guys have seen my videos in the past. We prefer silver, but we still have some gold. And what you can see here is this is the Van Eck gold ETF. And you can see gold stocks have broken out. I think that's a good thing. So it's wonderful to own gold stocks and seeing them break out and that kind of thing. But again, seasonally, you may see a little bit of a pause on that strength in the next couple months. Nothing wrong with that. It's a good place to hold. Just keep an eye on potential opportunities to be buying it. Now, seasonality does work against the gold ETF, the gold producer ETF, and this is the Van Eck gold miners ETF that we were just looking at. And you can see it often does peak in July and then take a bit of a breather for much of the balance of the year. So this is another reason that we should kind of keep a cautious eye on gold, at least for the next couple of months. The next sector I want to talk about insofar as maybe taking a pause between now and early winter is copper. Now, you guys know I like copper. Now, I'm very aware of the Trump announcement about Chile being able to sell copper in the US and copper prices fell. I think this is a short-term story. I am buying copper and other metals because of the long-term projections of the increased demand for copper and aluminum and other such products, base metal products, over the coming years with the development of AI, robotics, and even alternative energy, including nuclear and green energy. All of these require rare earths and require the basic products such as copper. So if you have a bigger picture on copper, I like it. However, over the summer, typically copper can take a pause, and this seasonal chart shows us that. It takes a nice little rally into July, which we got, but then it tends to see some weakness right into around November before it starts to pick up again. So that's a seasonal pattern, and already probably motivated by the Trump announcement a couple of weeks ago, but already we're seeing copper see a little bit of weakness. What does the chart say? Well, you can see that there is a little bit of a lid on copper. This is the producers, the miners, which is what I'm focusing on. And you can see that after a pretty strong rally, we saw a pullback again based on the announcement recently, but right at that resistance point. So it doesn't surprise me. I am of the opinion that you'll see copper bounce up and down around this lid and finally break out, but not for at least a couple of months. So new investors to base metals, maybe wait for an opportunity to buy, and existing investors, well, I for one am not selling, but I'm not adding to our positions too aggressively right now. So the next sector that I feel will not particularly do well until the coming winter is energy. Now, energy can be a lot of things, but we're mainly talking about oil and natural gas here. In fact, when you look at the producers, generally that's what is in one of those producer ETFs. And so this is no exception. This is the SPDR energy sector ETF, and you'll find that it's mostly oil and gas producers. So let's take a look at the energy producer ETF seasonality. And again, that's oil and gas producers largely. You can see that really starting in May and right through to the end of October, that sector is very flat. And absolutely, particularly oil stocks have been extremely flat this year. And my feelings are that you won't see that breakout right on schedule with the typical producer seasonality trend, which is to buy sometime in October, because you tend to get some movement over the winter and into early spring. In fact, that's where the real meat is between March and April on the producers. And I've seen this many, many times. It actually happens more often than not that you get a pop over the early winter into the spring. So for now, if you're buying energy stocks, particularly oil, I would probably hold what you got, but not necessarily be buying, because I think there's going to be lots and lots of volatility ahead. In fact, if we take a look at the energy chart, the same chart that we were looking at of the seasonality, this is the XLE SPDR energy ETF, it has in fact been flat for a couple of years. It does tend to have a tendency to move up and down in a bit of a pattern. It's trying to get to the top of that pattern, but I think it's not going to get to the top until next spring. So there's no hurry, as far as I'm concerned, to be loading up on energy. Now, you've heard me talk about natural gas. Natural gas has a different chart. I'm not going to talk about that today. You can go back and look at some of my recent videos and you'll see me addressing natural gas. Final sector of the sectors to avoid up until the winter are materials. Now, again, I like materials. Materials encompass base materials that almost all manufacturing use, forestry products, chemicals, plastics, that kind of thing is part of the materials sector. Very important part of the industrial sector. They have their rhythm. As you can see, over the summer, largely chemicals and forestry and base materials tend to move fairly flat. You can see that here. They don't break out until around November and move quite strong into the spring, just like energy that we looked at. So my 2 cents worth, again, there's nothing wrong with holding materials. You may not see any action on them until the winter, but I would be cautious about buying today because you may see lots of volatility and next to no upside for a few months. Again, the chart backs that up. You can see that it took a run after breaking out, failed, and is kind of likely to find support at its old support level from 2024. Unlikely to try to challenge that old high until we get back into the seasonally favorable period over the winter. Now I'd like to talk about some sectors that I think do have some upside in the coming months. We're going to start off with the VIX. Now, the VIX is not necessarily like buying a stock or a stock sector. It's really more of a hedge. And there's different VIX instruments out there. I would stay away from any leveraged VIX instrument. The other thing is they don't follow the VIX perfectly. But when the VIX is near a low point, you want to be taking a look at hedging your portfolio, because the markets, when the VIX is low, are showing complacency. And one of the things that I do is in our aggressive account, so ValueTrend has a conservative account and aggressive account. We do not play with hedges within our conservative account too much, but in our aggressive account, we will play with hedges, and we are currently offsetting the probability of a volatile summer through owning a VIX instrument right now. Now, I'm not going to advise you on which one to buy because they're very, very diverse in nature, and I'm not necessarily comfortable suggesting the one that we are buying because we are relatively short-term in nature. However, what you'll see is that between July and November, the VIX has its 3 best months of the whole year insofar as rising VIX prices. So you can expect that means that the stock market itself is going to be very volatile. That's why they call it the VIX, the volatility index. And for those of you who are comfortable with hedging, using some sort of a hedge against that volatility might be a trade you'll consider. Keep in mind that you can lose money on VIX ETFs because they move much more aggressively and they're not for the faint of heart. They have much more risk than buying a stock or a sector ETF. If we look at the VIX chart right now, you can see that it's trading near its lows. Now, the ultimate time to buy the VIX or to expect volatility on the stock market is if you see the VIX approach anywhere near 12, as you can see in 24. But typically, somewhere around 15 or so, we consider the VIX to be too low. We recently saw a touch of 15, so I wouldn't be surprised if we saw another test, as we saw many of those tests coming into 2025. And you guys know what happened into the trade talks. The market went fairly volatile. The VIX is signaling volatility when it starts getting into the upper end, and it's signaling complacency when it gets into the lower end. And so now it's playing with the lower end of that spectrum. Anywhere in or around 15, you might expect the VIX to rally off of that point. The final sector I want to talk about, insofar as a sector that should withstand the volatility that we can typically anticipate between August, September, and October, are REITs, real estate investment trusts. Now, I'm focusing on the Canadian REITs. That's because we at ValueTrend are buying the Canadian REITs right now. We think they're reasonably cheap. You can see that if you buy REITs in July, they tend to go up very nicely until around that period, October, November. So my feeling is that the REITs are offering both a seasonal opportunity and a technical opportunity. So let's take a look. This is the chart for the REITs. Now, we own this particular ETF, but we have more of a concentration in two individual REITs. The wonderful thing about REITs is that they're really not all the same. Like if you look at a bank ETF, Canadian bank ETF, they're all kind of the same. There's second-tier banks like Laurentian and whatnot. But for the most part, the banks all kind of do the same thing. REITs, not at all the situation. There are REITs that specialize in apartments and industrial and commercial, healthcare, all kinds of stuff. So don't necessarily only look at the REIT ETF. I would tear this ETF apart and look at each and every one of the individual REITs, because we found a couple of gems within this ETF. Yes, we own the ETF, but we own two specific ETFs, and I'm not going to suggest which ones you buy because, you know, there's so many, there's no right answer within the REITs. It's whatever your comfort levels are. But I do think the sector in general has some upside. So you can see that the REITs do tend to bounce off of pretty solid floor. I think you can see that. It's a pretty rhythmic move. And there's a little bit of a lid, which comes in at the old support level from way back in 2021. Well, my feelings are that since the recent neckline broke after the bounce off of that notorious bottom that the REIT sector does tend to bounce off of, my feelings are that you're going to see a return to near the top of this range, which lies somewhere between $16.75 and $17 on this ETF before the end of the fall. That's a good thing because you also get dividends on REITs. And again, they vary. Some of them pay very low, some of them pay very high. So you do want to take a look at the guts of this ETF before diving in and just buying any REIT ETF, because there's lots of good quality REITs to choose from. Whatever the case, the base chart here, the sector chart, is telling us that there's probably some good upside plus some good income that you can earn off of these investments until the market finishes its more volatile season. So a couple of announcements. On Wednesday, August 27th, I'm on BNN. I encourage you guys to phone in and ask your questions. Please mention that you watch my videos on YouTube. And I always tell the producers if they wouldn't mind pushing the people that read my blogs and watch my videos to the front of the line for questions, because we do get an awful lot of questions on BNN. So phone in and mention that you read my blogs or watch my videos, and we'll do our best to try to get you shoved to the front of the line. The next thing I wanted to mention is I'm going to be talking at the Canadian International Money Show, and that's in Toronto at the Metro Convention Center. That will be on September 13th, and I'm speaking at 4:30 in the afternoon. It's a Saturday. Now, I'm going to announce a special treat that I'm doing only for my blog and video watchers, and that is that I am going to, if you come to the Money Show in person, I'm going to do two things. A, if you come up to me after the show, because there's usually a number of people that gather around and ask me questions, and I'm happy to answer those questions. If you mention that you watch the Smart Money Dumb Money Show, or you read my blogs, I will give you, while quantities last, a copy of my very first book, Smart Bounce, for free. I will also autograph that book, and I will give you a code to get a discount that will last for the next 2 weeks to the end of September on my online technical analysis course. So there's lots of reasons. You have to be there in person. And if you can't make it, send a friend and you'll get your book, and we'll do the code that day only. So you have to be there in person. I keep saying that because I'm not going to give it away ahead of time. Thanks for watching, and we'll see you next time. Hey, thanks for watching. I hope you got value out of this episode. Please like and subscribe below. We're trying to grow the channel, and it would really be doing us a big favor. I'm presenting ideas every week on trades that we're actually looking at ValueTrend. And by the way, I don't just talk the talk, I walk the walk. I have been a portfolio manager for 35 years. And in fact, I was one of the very early pioneers in technical analysis here in Canada. On my website, valuetrend.ca, you will see a link for our online trading course. And this course is a complete money management system. I do encourage you to take a good look at that and consider taking it. I priced it extremely low because I want retail investors, that's you, to take the course and get value out of it. It's literally my 30 plus years of experience put into one complete step-by-step course. And honestly, I wish that I had had something like this when I was an early investor. It really will stop you from making so many mistakes. I also suggest you subscribe to our Never Miss an Opportunity program, which is our blog and our newsletter. There, you're going to get ongoing ideas, tons of charts, lots of trading ideas. And by the way, we never, ever solicit. We don't send you junk spam and stuff like that to try to get your business. It's for information, because part of my passion is to teach retail investors how to invest properly. I've been doing this, as I said, for 35 years, and I hope that I'm able to pass on some of the things that I've learned through this career as both a pioneer in technical analysis in Canada and a longtime portfolio manager. Thanks for watching. Don't forget, push like, push subscribe. See you next time.